Welcome to Girard's Monthly Market Update. I'm Senior Vice President Jim Jacobson, and with us today is our Chief Investment Officer, Tim Chubb. Thank you for joining. Today's content, we're going to share three things with you, and we're going to jump right into that now. So first up, Tim, tell us about earnings.
Yeah, so we're deep into earnings season right now. This quarter is actually supposed to be the worst quarter for corporate earnings growth since the second quarter of 2016. At the beginning of the quarter, most analysts were expecting S&P 500 earnings to decline by about 4%. And if you look back at the last 5 years, the average quarter has actually seen an earnings surprise coming in around 4.8%. So in other words, I call it the Wall Street two-step. If you reduce expectations low enough, it'll be easy to beat, and therefore we might not see earnings decline for this quarter.
So that's an interesting thing. You bring in a little bit of the market psychology. If you overpromise and underdeliver, the stock gets punished. If you underpromise and overdeliver, then stock's probably happy. So tell us a little bit more about that. Earnings are literally expected to decline, and yet we've had 3.5 great months so far in the market.
Yeah, earnings are expected to decline for the quarter, but actually grow over the course of the entire year. So right now we're projecting earnings growth to come in around 3 to 5%, but there's some things that could present a tailwind that ultimately drive earnings growth expectations up a bit further, like a dollar that potentially could be weaker than what is previously being expected. But I think the most important thing is a lot of the rebound that we saw in the last 3 months was just coming back from the capitulation and really unbelievable downward spiral that we saw in the fourth quarter, which was trying to price in a recession that ultimately hasn't been coming to fruition so far this quarter.
And I think that makes a lot of sense. There was so much tax loss selling in December. The bad stocks were getting sold because they were the bad stocks, and then profits were being taken in the good stocks. So there was literally no buying. It was just selling across the board. And then that abated, and January off we went. All right, Tim, second up on the list is the ever-present discussion of value versus growth. Tell us what we're seeing in the market currently.
Yeah, so really it's been another growth outperforming value year. And when we talk about growth versus value, we're referring to companies that exhibit more growth characteristics, that typically have top-line revenue growth, that's growing more quickly than the overall market. Value tends to be more mature businesses, well past their growth part and hyper-growth part of their cycle, and they're now looking to mature and maintain the portfolio of goods or services that they already have. Growth has outperformed value pretty significantly so far this year, and I think the key reason is because we're in a low-growth world. Investors are just more comfortable paying a premium for growth-oriented businesses, particularly in technology and consumer discretionary. On the other hand, a lot of other value-oriented companies have underperformed because, personally, I think they've not reinvested enough back into their business or had the ability to make acquisitions because of the debt loads that they have.
So an example might be millennials, for example. They don't really eat a lot of cereal, but they are raising a lot of pets these days. So a value-oriented company that wants to be growth has to maybe shift a little bit.
Exactly. Or just a technology company is able to grow because millennials or consumers in general are spending more time on digital media that they wouldn't have otherwise before, unlike newspapers.
And the debate will continue on and on forever. Okay, and our third topic, growth and the general GDP. So, Tim, it seemed like last year, as we faded into the fourth quarter, that earnings were not only weakening a little bit, but the actual economy was weakening, hence the Fed decided to go maybe on pause. But that was coming off of a pretty hot period for GDP early in the year. What are we seeing in the first quarter?
Yeah, so the first quarter is actually expected to be close to 3%. We have another reading coming out relatively soon. GDP estimates have come in somewhere between 2.8 and 3.1% for the first quarter of 2019. It's surprisingly high, especially how the stock market anyway, performed in the fourth quarter of last year. And however, I still think it'll continue to decelerate as the year goes on. Last year's economic growth was likely to be above trend. And so seeing 3% GDP growth over the course of the year, while it's nice and obviously it led to the Fed raising rates 4 times, is not necessarily going to be the course moving forward as we're in the late stages of this economic cycle. So while I don't think the economy is going to have 2 quarters of contracting GDP growth this year, I think 3% will be maybe one of the higher numbers we get, and definitely a most welcomed reading, given the market volatility that we saw at the end of 2018.
And that would make sense then, given that the Fed is looking to stay perhaps in neutral for at least the first half of the year and maybe all of this year, and probably a good place for them to be to let the economy just naturally progress.
Most definitely. I think that's a big piece and most likely going to help growth expectations. Really, the total change in stance that the Fed is and other global central banks have had towards more dovish policy.
Excellent. Well, again, this is Jim Jacobson, and I'm here with Tim Chubb. Thank you for joining us for this month's edition of the Girard Monthly Market Update. We look forward to seeing you again next month.